All right. Good afternoon once again. Welcome, everyone. My name is Odette, and today I am joined by Nikki and Caitlin, and we work for Plano Public Library. Some ground rules before we get going. While in the Zoom program, you can exit full screen mode by using the escape key on your keyboard or clicking exit full screen on the top right of your screen. During this webinar, your camera and microphone are turned off. If you have any questions, just place them in the chat box at the bottom of the screen, and Nikki will relay them to me if we can go over it while we're doing the presentation. Finally, staff cannot and will not offer any advice on choosing or evaluating any investment product or specific financial advice. This class is for informational purposes only, and the views expressed do not reflect the official positions of the Federal Reserve System or the Plano Public Library. So welcome to Building Wealth, and today we're talking about debt. This is a beginner's guide to securing your financial future. This series was created by the Federal Reserve Bank of Dallas to help you as you create a plan for building wealth. This is the last part of a three-part series. The first covered budgeting your money. The second covered saving your money. And now we are going to tackle debt. First, we will define wealth, clarifying what wealth means to you and your family. And then we will learn the language around building wealth, then the importance of understanding and controlling your debt, and we'll talk next steps. All right. Before we dive into how to build wealth, it's important to understand what wealth is. Wealth can mean more than having unlimited amounts of money. It's going to be unique to each person. Let us know in the chat or just think to yourself, what does being wealthy mean to you? Does it mean you can help your children with college expenses? Or maybe it means you're able to purchase a home. Keep these initial thoughts in mind as we learn more about building wealth and how debt relates to your building wealth journey. It's important to understand the language used around financial matters. Assets, liabilities, and net worth are three basic concepts that can help you better understand the steps to building wealth. Assets are things that you own that have value. And here are some examples: cash, savings accounts, retirement accounts, stocks and bonds, houses, cars. Assets can be divided into two broad categories, and what fits into each can change over time. We have assets and we have wealth creating assets. A wealth creating asset is a thing you own that has value, and that value generally increases. So what's the difference? A couch is an asset. You can sell a couch for money or trade it in for another item because it has inherent value. A couch is not a wealth creating asset because it decreases in value every year that you own it. A house, on the other hand, is a wealth creating asset, generally speaking. It will increase in value. Liabilities, and what we're going to focus on today, are debts, money you owe. These include credit card balances, mortgages, car loans, student loans, and other debt. Finally, a big component of your net worth and your building wealth strategy is equity. As an example, you can list your house as both an asset and a liability. The market value of your house is the asset. How much your house is worth, unless you own your home outright, you're going to have a mortgage. That's the liability, money you still owe to a bank. The difference between these two is equity, and equity contributes to your net worth. So with that, we have some of the terms that are important to understand before we dive more deeply into talking about debt. All right, understanding credit. Most people cannot pay for big ticket items or even smaller scale purchases in cash. meaning money that you have in your wallet or your checking account. It's sitting there ready for you to use. This is where credit enters the picture, and with it, debt. Credit is the granting of money or something else of value in exchange for a promise of future repayment. Basically, you're allowed to purchase something or borrow money by promising to pay back the value of the item or loan plus interest in many cases. Using credit is a necessary part of many people's financial journey, but it's important to understand that using credit means creating debt. And you have to be smart about creating debt to have a solid plan for building wealth. Your credit history is made up of a history of payments on loans and bills. Creditors use your credit history, credit score, and other factors like employment and income history to determine whether to lend you money, what interest they're going to charge you, and even how much money they're going to lend you. Because of this, it's important to review your credit report every year. A credit report is a summary of your credit history and other financial information. It's important to note that you can access your credit report for free each year from the 3 major credit reporting companies, Equifax, Experian, and TransUnion. They are all accessible through the same free website, annualcreditreport.com. You don't have to pay for that. The report itself can be accessed for free, but it doesn't include another major component of this picture, which is your credit score. Your credit score is a number generated from your credit history, and it is used to predict how likely you are to repay the debt you owe. So the higher your credit score, the less risk you present to a lender when they are deciding to lend you money. Your credit history and score are used for many things. Creditors, like we mentioned already, but also employers, insurance companies, potential landlords, and other entities may also use this information. So we understand how important it is to have a good credit report and a higher credit score. What affects these things? There's many things that affect your score, but some of the main ones are late payments, delinquencies, and defaults. They can negatively affect your credit score. So every time you pay your credit card bill late, that has an impact on your credit report, on your credit score, excuse me. On the other hand, paying your debt on time, your loans, your credit cards can help your credit score. Credit score and how it is calculated is a complex subject. There's a few more in-depth factors that affect credit scores, but these two are a good starting point for you to know about, and we encourage you to do more research. On the right, you can see there's a few more tips, but checking your credit report annually and disputing any incorrect information is a great first step. Your credit report can also include past addresses and employment history, and you are allowed to dispute any information on there that is inaccurate. So we have a basic grasp of credit and how it's used and how it can be used. Before you decide to take on debt, it's important to have a budget, emergency savings in place, your financial records, and knowing your goals. We discussed how to analyze your spending, create a budget, and make a plan to save in parts 1 and 2 of this series. Though sometimes using credit is unavoidable, it's important to understand the cost when you take on debt. Sonia and Vince both want the same TV that costs $1,500. Sonia on the left had a budget and a plan, so she decided to wait to buy the TV until she had enough in savings in cash to buy the item cash and thus not create more debt. Vince decided to purchase the TV on a store credit card. The TV itself is the same price for both of them, but because Vince financed the television, the store charges him interest to the tune of an additional $700 total by the time he pays off the TV. Interest is the cost of borrowing money or financing goods. When you repay loans or make purchases like Vince's TV, you pay the principal, the main amount borrowed, the base cost of the item, plus the interest the store, bank, or other creditor charges you to allow you to borrow that money. As you navigate the different loans and credit cards you can apply for, it's important to remember that taking on debt reduces your wealth. So remembering assets minus liabilities, i.e. debts, is your net worth. Other factors to consider when deciding to taking on debt are finance charges, annual percentage rate, fees, penalties for late payments, and more. These are all additional costs to you for using credit. This is money that cannot be saved or invested, which is why it's important to investigate your options before taking on debt. So we spoke about the steps you take before you have debt. You want to make sure you have a plan in place so that at the end of it, you can tackle that debt. For many, you already have debts of various types with different interest rates and fees. When creating your financial goals and making a budget, debt reduction may be a part of it. Sometimes it's an essential part of the plan before you can tackle other savings goals. So Vince has decided to tackle his credit card debt. Here we can see the different cards he has, the balance on each card, the interest being charged, and the amount that translates to each month. So you can see the difference, the different percentage rates on the amount. That is the cost of using credit if you're not paying off your credit card each month. Vince decided to use a balance transfer approach. He shopped for a new credit card with a better interest rate and then transferred all his credit card balances to one card. He used the savings from the interest he was paying to pay off this one card faster, more aggressively. Your debt tackling strategy may be different. What's important is to research your options and decide what fits best with your financial plan. And what's the basic step is to have your budget and your other financial records handy. Write down all your debt, all the debt you want to address, and choose a method. One last note, it's important to be aware of other risks when navigating credit. Credit is a great tool to be able to achieve some of your financial goals, like owning a house and taking on a mortgage. But there's a lot of risk out there by scams, etc. For example, when someone's credit score is low and they need a higher score to access loans or buy expensive items, they can be susceptible to scams such as certain credit repair services. These types of services claim they can erase your bad credit, but many are scams. There's no quick fix to raising your credit score, and this is where being a knowledgeable consumer becomes very important. Other pitfalls in loans and credit include payday or title loans. Payday and title loans are that you borrow against your paycheck or your car title. So these usually come with very high interest rates. And what happens is when someone cannot pay a loan back, they may be charged additional fees and may be forced to take on an additional loan to cover the first, and then the cycle continues. So you're never able to get out of the cycle of that specific loan. Predatory lenders also charge very high interest rates, and these include loans that aren't just payday and title loans. They often target low-income people and seniors. These types of loans also create a cycle like payday and title loans that make it hard for people to get out of debt. Some tips to remember is don't borrow from Peter to pay Paul. So we're preventing that cycle. Never respond to a solicitation that makes borrowing sound easy and cheap. It's important to do your own research and read the fine print. And seek assistance from family members, local nonprofit credit counseling service, and others to make sure a loan is right for you. It's always important to do your research and seek out a trusted family or nonprofit credit counseling services to see if you're making the right decision so they can help you do that. Finally, I'm going to go over some additional resources you can access and some classes coming up. If you have any questions, type them in the chat and we will address them at the end of this. You can access the Building Wealth website and its information online. The Building Wealth is what this class was based on, the content, and they have more information that we didn't go over today. The library has many resources to help you on your financial journey. The Morningstar Investment Research Center and the Value Line are databases available to card holders specializing in investment research. Popular books in personal finance, such as I Will Teach You to Be Rich by Sethi, The Total Money Makeover by Ramsey, and many more, are available in digital and physical formats. Some upcoming classes includes a class is actually today, Grow Your Business Cash Flow, where you can learn about the cash flow cycle and how to manage cash flow and ways to prepare for success. And it's presented by Capital One of our partners. It's today at 2 p.m. virtually. And then next week, we have another small business class titled Roadmap to Business Startup Success. This one's on December 12th at 6:30. And it will be in person at Schimmelfinnig Library, and it's also going to be presented virtually. And as we get to the end of the year, we also want you to check back for spring 2023 to see what we're going to offer next year in the first 4 months or so of the year. We also have a podcast if you're interested. And if there's any more questions, let us know. But either way, if there's not, a survey is going to pop up when you close out of the class. We really appreciate your feedback and thank you so much for joining us.